I think that right now there is a high probability that markets are about to enter a correction. Now I realize that this has probably been one of the most hated stock market rallies of all time. Everyone has been expecting the market to fall even while they've rallied 30 to 50% off their lows. And I mean everyone. From retail investors to hedge funds to economists, all the news has been bad and everyone has been bearish. I also think that this overwhelming bearishness is the reason why markets haven't corrected yet. Normally, markets correct after a period of abundant optimism, of overwhelming bullishness. And I think we are starting to see some signs of that recently. And combined with the fragile state of the economy and the markets, this could lead to very bad results. I am a long-term investor, and even throughout this rally, I've been averaging into stocks, even though I thought that the potential for downside was very real. But recently, I've actually started to take some profits in a few companies, and that's something I very rarely do. I'm not just basing this on valuations, which everyone agrees are stretched. Let's just take a look at this data out of Yardeni Research. As we can see, the forward P for the S&P 500 large caps is at the highest level since the end of the dot-com bubble. The charts for mid and small caps are even more stark, with the current forward Ps exceeding even the very peaks of the dot-com bubble. And finally, the S&P 500 price-to-earnings growth ratio. This ratio represents how much you are paying for future earnings growth of a stock. Prior to the crash in February and March, we were already trading at higher PEG ratio levels than at any point in the last 25 years. And as you can see, the chart has gone absolutely parabolic as a result of companies' earnings growth decreasing much more than their stock price has. Meaning now you are essentially paying a lot more money for a lot less growth. But none of that really helps us determine whether a correction is imminent. Overvalued stocks can continue to become more overvalued for a very long time. But right now I see somewhat of a perfect storm hitting stocks over the next few weeks and months, which I think could tip the balance and lead to another big downward move. There are three main factors that lead me to this conclusion. The first is the resurgence in the global pandemic. The second is the slowing down of central banks providing liquidity. And the third is the weakening momentum in the major stock market indices, particularly in the Nasdaq, which is most concerning, as it has been the clear and undisputed leader, both during the current rally and over the last several years. First and most important, let's talk about the global pandemic. Now, most of you are probably tired of this topic by now. I know, it's been kind of played out, but if you've kept up with it and have been following it over the last few months, then you've probably noticed from around April 1st to May 15th, the worldwide daily new cases were pretty much flat, as economies were shut down and governments around the world implemented restrictions. Also worth noting is the interesting fact that markets just happened to bottom out right around the same time when the growth rate of daily new cases started to flatten out. And as you can see now, we're not so flat anymore. Ever since mid-May, for 9 weeks straight, daily new cases have grown every single week without fail, which is to be expected given the global economic reopening. What's even more concerning, though, is the rapid acceleration of growth in new cases over the last few weeks. The growth is starting to appear parabolic as it did back during the initial surge of cases in March. The United States in particular has seen a major uptick in cases, as well as a very high positivity rate coming out of certain states. The good news is that the world is certainly more prepared now than they were 4 months ago. Though new cases have been growing for the last 2 months, give or take, daily deaths have not risen and are actually now down significantly from their peak in mid-April. But the issue is that if we continue to see an exponential increase in cases, similar to what happened in March, the death rate would eventually start to spike up as well as healthcare systems become overwhelmed. This would force economies to shut down again, or at the very least implement more strict restrictions, and many people would start to become fearful again. Needless to say, all of this would be very bad news for markets. This would really put a damper on the thesis of a global economic reopening and recovery. Second, let's take a look at the Federal Reserve's balance sheet. As you can see, after a massive increase over the prior months, it has been flat over the last month, and as of June 10th, it's actually been in decline. Now, this could, of course, change at any time with the introduction of additional liquidity programs or the ramping up of existing ones. But this is the first time in 4 months that it has actually declined, so it's definitely significant. Though the Fed does not directly affect the prices of stocks, at least not yet, they do directly help out the companies behind the stocks through the purchase of corporate bonds, as well as through lowering interest rates and providing liquidity to the banking system in general through their repo operations. Given the rather unstable political and economic environment at the moment, I think that if the Fed's balance sheet were to continue to decline, stocks would eventually follow. Of course, the Fed would eventually have to step in again and plug the holes. They've demonstrated that they're very willing to do whatever it takes to support markets. They've already added almost $4 trillion to their balance sheet over the last 4 months, and their purchases of corporate bonds are ongoing. But that doesn't mean we can't have another big correction. And finally, let's look at the technicals of the market. I don't base many decisions off technical analysis. I buy companies for their fundamentals and future prospects. However, I do think there is some value in looking at certain basic indicators and what they can tell us about the current state of the market. This is the NASDAQ 100, also known as the QQQ. It's the only one of the 3 major US stock indices to have made a new all-time high after the March lows. There is very clear bearish divergence forming currently on the daily chart. As we can see, the NASDAQ has made 3 higher highs, but the momentum indicators, the RSI and the stochastic RSI, have made 3 consecutive lower highs. This is not necessarily something you want to see after a breakout to new all-time highs. Though the trend is still inherently bullish, given that it's making higher highs, the fact that it's making lower highs on momentum indicators indicate weakening momentum. This is a counter-trend signal, indicating a potential reversal. As we can see, the charts did a very similar thing back in January and February, right before they went to fall off a cliff. What's much worse, though, is that the bearish divergence is present on the weekly chart, and here it is even more obvious. As you can see, the chart has clearly made a new all-time high, but the momentum indicator is significantly lower than the previous high back in February of this year. While these indicators are not signals that the market is about to fall, they are signals that the market is weak and could be vulnerable to any shocks. Shocks like the resurgence of the pandemic or the lack of intervention from central banks. So where does that leave us? While I believe markets are currently in a precarious position, I would like to see sentiment become more bullish before I'd be confident in calling a market top. If sentiment remains neutral to bearish as it is now, we may simply see a minor correction of perhaps 10%, or a market that trades sideways for a while. If we start to see more activity like we did in mid-May to early June, where the markets rocketed higher and many beaten down risky stocks rallied 50 to 100% in just a couple of weeks, I think that could be the blow-off top that precedes the next major correction. Keep an eye on stocks like Boeing, airliners, restaurants, and distressed retail. I'm also keeping a close watch on the mega-cap tech stocks that have led the markets. Weakness in names like Microsoft, Facebook, Apple, and Google, which all show weakening momentum, could spread through the entire market. These stocks are considered the safe havens of today and are priced for perfection. Personally, I'm currently about 30% cash, with the rest being invested in long-term positions. I continue to search for and buy stocks that look to be attractively priced, and it's definitely possible that I may be wrong in my analysis here. But I think the probabilities favor having access to cash right now. And if stocks start to tank, I will be there to step in and load up on some of my favorite companies. I hope you enjoyed this presentation today. If you did, don't forget to leave a like, comment, and subscribe if you want to see more.